Welcome to the Executive Compensation Podcast. I'm your host, Ryan Harvey, and on this episode, I'm joined by Jim Heim and Kartik Balaram. Jim works out of our Boston office, and Kartik works out of San Francisco. Jim, Kartik, welcome to the podcast.
Hey, thanks, Ryan. Thanks for having us.
Yeah. So, for senior executives at most public companies, performance based long term incentives make up the largest single component of pay. Performance LTI is typically intended to align executive pay with shareholder interests and ideally support the strategic direction of the company. But how should compensation committees actually go about evaluating their LTI arrangements to determine if they are supporting their business as intended? On today's conversation, we'll explore this topic further with Jim and Kartik. So, Jim, maybe to start with you, I would like to just hear, your thoughts on where compensation committees should be spending their time. They spend a lot of time on performance-based LTI. It's a big part of the annual calendar and discussion. But where should they be focusing their attention when it comes to long-term incentives?
Yeah, right. Well, it's a broad question, right?
Yep.
Now, as you said, I think there's widespread consensus. LTI is supposed to foster a series of payments that are sensitive to value creation. It's supposed to be performance-based pay. The ultimate measure of performance, it's long-term sustainable shareholder returns. So that's one thing it's supposed to do. It's also supposed to be retentive in that the payouts are spread out over time. I also think everyone understands there's some tension between those two priorities. LTI should be at risk, responsive to the shareholder experience, but it's also supposed to keep people in their seats, engaged through both up and down cycles. So what I see is a lot of the debate and discussion in committee meetings, it really relates to reconciling that tension and trying to find balance between awards that are going to be retentive, but also sensitive to value creation. Um, I would suggest that reaching consensus on design, it becomes a bit easier if you start out with the premise that pay, it's not a tool that drives value creation or strategy. That's backwards. Um,
Yep.
by way of example, you and I, Ryan, I know we both work with companies that have EVA as a key performance measure. And if we think about a company that starting tomorrow, it just said, we're implementing a pay program. It's going to be based on economic profit. It's going to be based on economic profit alone. But Bennett Stewart hasn't been walking the halls of that company. No one's been getting the whole company up to speed on how to calculate returns on invested capital or their weighted average cost of capital. Is the quarterly business reviews, they're not using that vernacular. Decision systems, they're not supporting M&A that don't embrace EVA as a concept. All the underlying formulas, bottom line, they're not understood by the workforce. So just putting in a new economic profit-based pay program, it's not suddenly going to unlock value creation. And that's because pay is not a tool that drives value creation.
Yep.
What you do first is you figure out that value creation strategy. So in that case, you embrace the EVA concepts. You embrace them in your decision-making processes. You make it part of your day-to-day lexicon. Then you leverage it in describing the business strategy to investors. And only then do you make sure the pay system rewards implementation of that strategy. I think if you take that worldview, that agreement on value creation is fundamental, then the committee deliberations and LTI design, it's not going to be this chaotic kitchen where there's a dozen chefs arguing over the same omelet. You've got a single recipe. And the range of potential alternatives, it's going to be narrowed because there's fewer competing perspectives of what it is you're trying to accomplish.
Yep.
And when
Yep.
it's working well, yeah, pay is sensitive to, it's responsive to strategy, but it's not driving the strategy. So step one, articulate the value creation strategy. Step two, make sure the pay system rewards successful implementation of that strategy. Step three, you make sure you have mechanisms in place to foster alignment with long-term. And I guess I should be more specific here. Long-term, I'm not saying 1 to 3 year periods, maybe 5 to 10 year periods, but you want mechanisms in place to foster alignment of the rewards with long-term sustained value creation.
Yep. Yep. No, I think the excellent point. And As you said, you're not going to drive behaviors typically at the executive level with really any incentive plan, but particularly long-term incentives. But you can align behaviors, and I think that is one of the critical elements is to say, let's make sure that pay outcomes are aligned with shareholder outcomes and with business
Yeah.
outcomes. So you can align those things, but trying to change behaviors with pay only, it's a pretty blunt and not very effective tool for doing that. So Kartik, would love to hear maybe some thoughts from you around, where committees should start. Anybody listening to this podcast, they've got various long-term incentive arrangements that are in place. What are some ways that they should evaluate those LTI arrangements to start thinking about, are these supporting business strategy and are they aligned with the shareholder outcomes?
Yeah, and I think, first off, it just doesn't start with a benchmarking analysis, right? Like we can look at what plan designs of your peer groups look like and, what the common plan design and mechanics are, but it shouldn't inform specifically, what the value drivers are to the business, as Jim pointed out. So I think step one is really getting the committee and the management team into a room and really hashing out, okay, what is the 1 year, 3 year, 5 year strategy in terms of business strategy and value creation. And, as you think about, what those factors are, do our current incentive programs support those value driving creators? And if not, what do we add? What do we cut? What is the, performance horizon? What percent of target pay is attributable to those specific value creators? That's really the conversation that needs to be had up front, and really consensus needs to be made before before really understanding, okay, is the LTI program working? Once that's done, if there's certain straw man models that, the management team wants to come up with in terms of balancing out, the performance measures, there should be some scenario modeling in terms of, okay, what could potential pay outcomes look like, from poor performance all the way to stellar performance? So what are the compounding effects of those specific, each of those different performance criteria? You should also make sure that you have time-based equity within the program to balance out, you have the leverage, you have the performance orientation, but if things don't work out, is there relief or is there downside protection in the cases where pay for performance may not necessarily be met for a certain cycle? And then also, looking, sort of adding to the compounding effect, if there's a single cycle of performance awards that sort of overachieves, does it make up for prior years of poor performance or potentially future years? So you run into this situation where you have cycles where you might have winners or losers, and you want to be able to balance that out.
Yeah. So I want to throw out just a kind of a quick side question here for either of you. Would love to get your opinions, and I know there's varying opinions on this topic, but we're talking about ways to evaluate these programs, and a lot of things, Kartik, that you pointed out would definitely apply to different financial metrics and making sure those align. But there's the obvious question of, if we're just talking about alignment, let's just pick, share price and use TSR or use some sort of absolute share price as the performance metric. What are your thoughts of, like, using share price? Should we just focus on simplicity and just use share price, or is that not always the right tool for alignment? I don't know if either of you have a quick thought on that topic.
Well, I'll start. I will say that I absolutely have dealt with companies in some sectors and at some point in the life cycle where share price is not at all a bad place to both start and end the conversation. If you've got a company that hasn't yet reached commercial operations, if you've got a company with a very volatile stock price, yeah, share price, it accomplishes a lot. You've already got a team in that case that likely understands there's a lot of risk embedded in this company, whether we're going to make it or not. We already understand that the multiplier, if we're doing things well, it's not a case where, oh gosh, the stock price might go up 10% if we accomplish all that we want to accomplish. No, it could go up 3x, 5x, 10x. And with that being the situation, I don't know that you necessarily benefit from adding additional performance measures on top that say, oh, and by the way, if you accomplish A, B, C, you're going to get twice as many shares.
Yeah.
You're already in a wonderfully aligned in terms of how the executive team is going to realize value, and how investors are going to realize value. Maybe after commercial operations come into place, as companies start to become more mature, it starts to become much more of a debate. And the primacy of share price and share price alone, sure, it drops a bit.
Yeah. Yep. No, definitely. It definitely checks the boxes of simplicity and direct alignment to shareholder outcomes. But uh, so, Jim, I'd love to hear some additional thoughts from you just on effective LTI approaches. What are some of the principles? What are some of the things that committees should be thinking about as they actually get into the real designs of their programs?
Yeah. And, it's probably easier to talk about what effective programs don't look like. Um, when we started this conversation, we were acknowledging there's tension between optimizing plans for retention, optimizing for that alignment with value creation. Um, there are some clues, some hints that you're erring on the side of optimizing for retention. If you're using nothing but time-based restricted shares, or if you have found yourself in a pattern where it's almost like drawing a hamster wheel of make whole awards. Every year there's some type of supplemental award, or you're making up for some missed opportunity, or you feel that you're under pressure to make off-cycle retention grants because you didn't meet performance goals. Let's be honest, at that point, um, all you're focused on is retention. You've lost the lens to holding management accountable for performance. I do think it's helpful if management teams have a certain amount of unvested equity awards that are representing some type of multiple of their salary. But when we're doing those type of analytics, we can never lose sight of the fact that the management team is supposed to be generating the performance that earns that multiple of salary. Those equity awards, they're not a gift. It's not a matter of, regardless of the shareholder experience, you're always going to have 5x of your salary because we need to do that to retain you. At a certain point, you start questioning, what are you retaining? Are you retaining a team that the rest of the market probably wouldn't have a lot of interest in, given their track record? On the other end of the spectrum, if you have in all our eggs are in one basket, we've done a front-loaded mega grant, it's denominated in options, they're only going to pay out if we hit certain performance standards. Kartik, you were talking about this type of program earlier. A lot of times those programs, they really end up being this heads we win, tails you lose proposition. Because if you hit the performance standards, everyone's thrilled, right? The investors, they've realized value. Their investment's doing great. The executives, they feel their efforts have been rewarded. They absolutely feel, they've earned all these rewards and all these great multiples off of the intended value. But what we probably see more often is what happens when you miss the performance standards. And I know I've seen that play enough times to know how it ends. If it's still a viable company, you're going to be providing supplemental awards to restore what's a broken incentive. And your investors are going to be furious. I believe we've seen how this ends enough times to kind of know how it's going to play out. So first of all, you don't want to err too far on either side, just entirely focused on retention, or just putting all your eggs in one basket on everything being performance denominated.
Yeah. Yeah. So yeah, no, those are definitely some good examples of things you want to try to avoid, and things we've seen clients kind of get themselves into some trouble. But what about successful programs? Are there
Well,
some things that you would point out that companies should really be trying to kind of
yeah,
strive to design?
yeah. Well, first of all, I would say a core feature of programs that stand the test of time. So they're keeping executives engaged. They're keeping them retained both in up and down cycles. They're managing to reasonable levels of equity spend. Um, they're not having a lot of out of cycle awards. One of the common features of those programs, time-based RSUs are present. I'd say the sweet spot, it seems to be 1/3 to 1/2 weighting to those time-based RSUs. And as for the PSUs, the timeframes for measurement, they have to be in line with your ability to forecast. I would say it's silly to feel you have to have a 3-year performance period on revenue growth if you're in a cyclical sector. If you know on day one that your management team, they don't have a great amount of ability to influence what revenue is going to be 3 years from now, um, using a shorter time period, it's preferable. It mitigates the risk of those disaster outcomes where you're paying nothing, even though your performance might actually be strong relative to the sector. It's mitigating the likelihood of windfall outcomes where you're paying out well above target for performance that in retrospect looks like you're trailing the sector momentum. It's not a bad thing to have less than 3 years of a performance period. You just have to explain to investors why you're doing that. Um, let's say your company's in crisis, like it's a true turnaround scenario. Uh, I would argue at that point, a relative TSR plan, it's a worthless measure. If your investors came into your stock at $100 and you're now trading at like $20, relative TSR doesn't matter. Let's say your sector is delivering returns of 10% a year. We can do the simple math there. Over a 3-year period, it's only got to go up 33%. So over 3 years, you might go from $20 to $26 and change. Your investors came in at $100. You really think that you want to pay out at target in that scenario? You're not going to be paying anyone anyway. In that scenario, frankly, you're not going to be a standalone company anymore. You quit from $100 to $20 and you're not coming back up. So, relative TSR, this we pay at for median performance, I would get rid of that. If it's a turnaround, absolute stock price measures or nothing. On the other end of that spectrum, companies that are doing really well, ones that have had fantastic growth, I think it's reasonable to recognize that incremental performance, well, it becomes incrementally more difficult. I think there's a reason growth stocks, they eventually become value stocks. You've already captured market share. You've expanded margins. All the low-hanging fruit, you've taken it off the tree. So when you're setting goals, they got to reflect the reality of the opportunities you have available to you now. Not just we've grown 10% for a decade. Of course, we're going to plug in 10% next year. If you've hit 10% EBIT growth every year for a decade, well, it's quite possible the scenarios that you're looking at going into 2026, they might be less than that. That's okay. What you're rewarding management for is creating value with the opportunities that they have available and also making sure that, that you're creating shareholder value. Shareholders probably recognize that the endless growth engine, at a certain point, it transitions to we are realizing the value, we are receiving the dividends, et cetera.
Yep. Yep. No, I mean, all very good points and things to think about. And it kind of triggers a thought, Kartik, that I'd like to get your thoughts on, which is, look, where do the proxy advisors come into all of this? So, some of the things that Jim mentioned to avoid, those are things that the proxy advisors would also tell companies they should avoid. But interestingly, when you think through some of the things that he just walked through, which are practices maybe to consider, some of those are painting a little bit outside of the lines of what the proxy advisors, might find at least to be a best practice or even an acceptable practice. So, where would you advise clients to think about how proxy advisors should fall into this? Should they just kind of keep their heads down and follow exactly right in the middle of the approach that the advisors are requesting, or should we think about going maybe outside of those boundaries?
Yeah, I think everyone sort of runs into the trap of falling into the, compliance, what the proxy advisors view as quote unquote best practices and just sticking with that. But the reality is that every business is unique and, there's different nuances to each business cycle. Like Jim mentioned, you have businesses that are cyclical. For growth companies, it's hard to really project out long-term performance. So when we're thinking about it, 3-year performance periods are the most common, and that's what, the proxy advisors view as a good performance period. But for a growth company, maybe a 1-year period makes more sense, maybe 2 years, maybe each, single years, 1 year, 2 year, 3 year. They view relative performance as a good way to measure performance. But in reality, in volatile industries, it's hard to really measure, what's you may be at the bottom of the group, but you've had a great year based on certain milestones that you have in place. They prefer multiple measures within the program. Is that the right move for a company that's in either growth mode or cost saving mode? And really, I would say, the one piece that comes up a lot with our clients is, why does a target measure in a given year need to be higher than the prior year's performance, right? There might be different nuances that take place when people are going through their performance goal setting process. So all those items, I think, kind of point to the fact that compliance doesn't really help solve what the retention challenges companies may have, what performance or value creating drivers that they have on the table. It just builds a structure that's consistent and kind of cookie cutter, but it fosters alignment with proxy advisors, but not necessarily, the value creation process or the business cycles. And is it sustainable really going forward? And then I think, this notion of having, multiple measures in the short-term incentive plan or the long-term incentive plan, that runs the risk of diluting performance. If profit is a huge value driver and you have top line and bottom line and it's weighted equally, you're diluting the value creation driver. So I think really what companies need to do is spend a little bit more time on the goal setting process, really focus on what we talked about, what are the key value creating drivers, and focus more on the 1 year, 3 year, 5 year outlook rather than just, each year replacing or adding goals.
Yep. Yep. No, I think as you're saying, ultimately as a committee and a board, you have a fiduciary responsibility to create value for shareholders, and that doesn't always fall right within the kind of neat guidelines that the advisors are laying out for you. You don't want to be surprised by what the
Yeah.
advisors are going to say, but as you're kind of indicating, they shouldn't necessarily also be guiding guiding decisions.
And I think it's really a matter of, knowing what the proxy advisors like to see, but
Yeah.
being ready in your proxy disclosures to really provide the rationale around why you set up the structure the way it is. Right.
Yep. Yep. So Jim, maybe you can give us some final thoughts just around any other kind of long-term incentive traps or things that you've seen, companies fall into that they should try to avoid when it comes to long-term incentives.
Okay, traps. There's a lot of traps. Um, well, here's a fun one. And Ryan, I know you get these type of requests. Oh my God, Kartik, I know you get these. The request that just says, we're looking for something that's innovative.
Yeah.
And then you start probing and you find that what the client is saying, it's not really give us something novel that's never been seen in this industry. What they're really saying is, what we're doing right now isn't working. We want to do something different. And that's great. But what the client's asking for, it's not really an innovative program. It's an effective program. And that effective program can be the same type of a program that 500 other companies are using. And it could be perfect for this company. It just hasn't been used there before. So one of those traps is just, describing something as we're on a search for innovation. All of us, we've seen hundreds and hundreds of designs, everything under the sun. Uh, the task for any committee, I don't think is necessarily, we have to create something that has never been seen. We have to create something that's going to get the job done here. I think there's two tenets that probably help with avoiding traps. One is recognizing old isn't broken. As an example, a regular pattern, stock options and RSUs. No performance shares at all. That's incredibly dull. It's also incredibly effective at a lot of companies that are, let's say that they're in cyclical sectors, they're growth sectors. It's the type of company I was talking about before that might still be building out commercial operations. That type of program, options in the RSUs, if you're granting on a regular basis, annual refreshes, you're not getting into this mega grant trap. Well, it's going to be sensitive to shareholder returns. It's going to be retentive through all cycles. As I think about it, over the last 15 years, we've had these waves of option-like performance share programs that have entered the market that probably existed for no other reason that companies felt they had to use performance shares instead of stock options because of proxy advisor critiques like Kartik was speaking to earlier. There's market share programs. There's all manner of quirky relative TSR plans. There's premium priced options, etc. A lot of these are putting bells and whistles on a base vehicle that works pretty darn well, and that you can explain to investors why it works for your company. My favorite category of board member, and it's somebody who's been an operator at some point. They've worked across multiple sectors. They've seen both up and down cycles. Because of that, they know there's this broad array of performance share programs out there. They know that there are a lot of designs, but they also know a high percentage of those programs, they're not going to make their situation better. They're going to make it worse. What's great about those directors, they have experience that allows them to isolate a narrower set of solutions that are worth pursuing. You don't have to throw everything against the wall. And no company should feel like it has to throw everything against the wall. Second thought, simple is not dumb. Simple programs, they're transparent, they're easy to explain. And because of that, they have higher perceived value for recipients, and they generate less skepticism from investors. This is probably reinforcing some of the things you were saying, Kartik, but yeah, I feel a lot of repetitions with technology companies where we quickly reach consensus that, some combination of revenue growth, EBITDA margin, it's the real value drivers. But for some reason, we feel compelled to find modifications or a third measure because it can't be that simple, right? There has to be something else. In some cases, it really is that simple, and that's okay. Come back to the biotech example. The underlying stock price, it's incredibly sensitive to reaching certain milestones in clinical trials. So it's the type of thing, stock prices go from $10 to $30 overnight. If you already have that type of sensitivity, do you really need to earn more shares for achieving the milestones? Everyone in the industry, they understand that dynamic. They are already incredibly focused on meeting the milestones. Simply adding performance shares that say, oh, and by the way, if we progress to clinical trials, if we get to positive news from the FDA, you're going to earn 50% more shares. I don't know what problem that's really solving.
Yeah.
Time-based RSUs, the company with some stock options, they will check the box for a lot of those companies, at least until they reach commercial operations. So I guess, in summary, I'd say added complexity, it doesn't necessarily mean that you're adding refinement or improvement. Sometimes it's just added complexity. I would say that that's probably the largest trap that we work to avoid.
Yeah, no, the great concepts to consider and principles that I think are just really helpful to think through as we're thinking about long-term incentive design. But want to thank both you, Kartik and Jim, for coming on the podcast today. I think this has been a great conversation, and hope to talk to you guys again soon.
Same to you, Ryan.
Great. Cheers.